So in terms of highlights, from an accounting perspective, our total profit is up 50% to just over 64 million. We've had a 10% increase in EPRA earnings, and we also grew the dividend over the year. Our gearing is slightly lower at the year end. Operationally, our property portfolio has outperformed MSCI IPD quarterly benchmark over the year, but also again over 1, 3, 5 and 10 years. We've grown occupancy in the portfolio as well, which is particularly pleasing. And over the year, our NAV total return is just under 15%, which again, we're very pleased with. Well, the commercial market, I think, has been very resilient in the face of Brexit uncertainty. In fact, over the last 12 plus months, capital values have actually grown month on month, which is very encouraging. Clearly, there's some sectoral differences there, and the industrial warehouse logistics sector has performed very well, but the retail sector actually has struggled, and the high street news of recent months really reflects those difficulties. So from Picton's perspective, we actually delivered a return at a property portfolio level of 13% compared to the wider market at 10%, and that really reflects our overweight industrial warehouse logistics bias and underweight positioning to the retail sector. So in terms of our own portfolio, we think we're well positioned as we look forwards. We have no real plans to dramatically change our exposure. What's interesting, I think, is that in a lot of markets, supply of floor space is quite tight. That means that rents are positively moving forwards, and that's a good dynamic, and we think positive for returns going forwards. They might be limited in terms of capital movements and yield appreciation, but rising rents will also have a positive effect. Well, for us, it's very much business as usual in terms of managing the portfolio. We've got high occupancy, certainly in the industrial and retail sectors. It's a little bit weaker in offices, and that's clearly where we can lease up voids and grow income. In terms of selective buying, selective selling, repositioning the portfolio as we have done in the past year. So in terms of our income profile, we've got reversionary potential, just over 6 million of reversionary potential in that income, i.e. how we can grow it from leasing space at today's market rents versus the current contractual rents payable. And the active management that we'd be looking to do is unlocking that potential, and through that growing our underlying earnings. Because of our portfolio positioning, there aren't any major plans to significantly change sector weightings or geographic exposure, for example, and very much following our kind of occupier focused opportunity led approach. If there are opportunities in the market that we think are attractive, then we have firepower through revolving credit facilities, etc., to take advantage of those. Similarly, if we think we can achieve very good pricing on certain disposals, that might be something that we look at too. In terms of REIT conversion, our aim is to become UK tax resident and enter the REIT regime effective 1st of October 2018. This all flows from proposed changes in legislation that would adversely affect Picton and lead to a higher tax charge in the coming years. So the way to mitigate that is to enter the UK REIT regime, which will equally have a positive effect of reducing our tax liability. We will be seeking shareholder approval to the changes at an EGM in July, and we will be sending circular out to shareholders very shortly. So in terms of being a UK REIT, as far as shareholders are concerned, Picton will have a very similar look and feel to how it is currently managed. The key is around management and control in the UK, but in terms of our portfolio strategy, I think it's fair to say that there'll be limited change from that perspective. And in terms of dividends, just looking forwards, once we have entered the REIT regime and we are dealing with the requirements of that, we'll relook at the dividend policy. But overarching that is the savings coming through the REIT regime rather than anything the other way.